Hi guys, it's Marissa here, author of The Rise High Investor, and thanks for tuning in to another one of my weekly videos where I share with you information, tips and tricks to help you on your property investment journey. And the whole aim of my weekly videos is to help you achieve your property investment goals and your financial dreams. So I hope that they're doing that. Today I'm going to be talking about cost base and why it's important. Now, many people probably don't even know what this means. And it doesn't normally become relevant until a point in time when you come to sell your investment property. But let's delve into it so that you understand what cost base is and why it is relevant and what sort of things you can do to influence the cost base at the point in time when you come to sell your property. The cost base is relevant because your accountant will use the cost base of your investment property determine what your capital gains tax is and what your capital gain is at the time that you sell your investment property. So how is the cost base calculated? Well, it is quite complicated and you do really need your accountant to help you with this calculation, but I'm going to just simplify it and tell you some of the things, some of the components that go into it so that you understand what influences your cost base. Your cost base starts with the price you paid for your investment property at the date that you purchased it, plus any incidental costs of acquiring the property. For example, your stamp duty, your conveyances fees, things like that. Plus any maintenance or repairs that you've done on the property in the first 12 months after purchasing the property. So these are the repairs and maintenance that you did within the first 12 months after purchase that you were not able to claim an immediate deduction for in that financial year. So there you go, that's what we've got in the cost base. We've added all those things together to bring the cost base at the time that you purchase the property. What happens is, as you own the property, if you are claiming depreciation on the property, the amount of building depreciation that you write off whilst you own the property gets deducted from the cost base. So the cost base will actually reduce by the amount of depreciation that you've written off throughout the life of you owning the property. And then we will add back the value, the difference in the value between the plant and equipment from the time that you purchase the property to the plant and equipment value at the time that you sell the property. So like I said, there is complexity to it, but at least you have an idea of what goes into it and what makes it what it is at the time that you sell your property. It's really important that you get your accountant to help calculate this for you. And I would suggest that if you are thinking of selling one of your investment properties, that you get your accountant to calculate it before you decide to sell so that you know what you will be up for as far as your capital gains tax expense and liability will be at the time of sale. I can't tell you how many times I've had people come to me who have gone to sell an investment property only to realise that by the time they pay off their loan and the capital gains tax, because they've been leveraging against the equity growth of that property over the years, they're actually in the red after they sell the property and have to take out another loan just to fund the capital gains tax liabilities and pay out the debt against that property. So it's really important to understand, if you are going to sell an investment property, know what your cost base is, know what your capital gains is going to be, know what debt you have to pay out with the proceeds from the sale to ensure that you're not going to be left in the red from a cash flow perspective following the sale. I hope that helps today, and as always, I really enjoy receiving your thoughts and comments and questions. You can contact me directly at the email address propertyinvestor@risehigh.com.au. As a special bonus for tuning in today, you're also eligible to get a 50% discount off my book. All you need to do is hop onto the website, that is risehighinvestor.com.au, and enter the code word video when you go to the checkout. Thanks so much for tuning in. We'll see you next week. Bye.